goes a long way. All right, welcome back, everybody. I know we did not have a stream this morning, so I decided to hop on real quick, do a market outlook. We typically do these market outlooks private for VIP members, but today decided to do it public because we have an FOMC meeting tomorrow. Now, I know what's on everybody's mind. This is obviously, it's a crazy week, big topic. Who's my barber? Does he deserve a Nobel Peace Prize for this? He does. Okay? Just give him the Emmy right now. Give him a Purple Heart. The greatest barber ever. No, but on a serious note, let's talk about meeting predictions. Let's talk about what the largest banks have already put out, and then we'll talk about market predictions for tomorrow. Any questions before we get started? Thought so. Let's jump right into it. Tomorrow, FOMC meeting. Jerome Powell hits the stage to break everybody's heart. Everyone was expecting the 7 rate cuts this year. We've had a bullish run on all indices, specifically the NASDAQ, which, as you guys know, for me is more of it's a proxy for, obviously it's a technology sector, but it's a proxy for risk tolerance or risk appetite. So because the majority of the names in the Dow Jones, for example, or S&P 500, they're cyclical stocks, so that means they move with the market cycle, or they're industrials. You're not really speculating on Home Depot, right? You might buy more if you think there's going to be more home building or there's going to be new home buyers entering the market. But as a whole, pretty stable industry there, kind of just follows the business cycle. When you look at technology is more of a longer term bet. You're speculating with high risk, high upside. So if you buy a chip manufacturer, you know, the ones that make chips for all the technology that we use, computers and phones. If you buy a chip manufacturer and they go to zero, you lost your money. You were betting on the future. You were directionally correct. You had the right industry, picked the wrong name. And so that's why the technology stocks are more risky. And that's why I use NASDAQ as a proxy for risk tolerance. So we've seen a massive run showing us that risk appetite has been huge. Everybody's been risk on, selling off treasuries, selling off just any type of bank notes. So like CDs, credit or certificates of deposit, and other things where people were parking money with low, they were parking their money with low returns, and they're putting it into higher risk instruments. So that's why you see crypto is pumping now, and obviously we've had a stock market boom. Is the party going to be over when Jerome Powell hits the stage to remind everyone that wage inflation is still going up? And if everyone's getting paid, I've been screaming this from the rooftops. I want you guys to finish my sentence, see if y'all are paying attention. We cannot bring prices down if wages keep going up. Because if people are making more, finish the sentence. I speak Spanglish. What is your real name? Yo, what up, bro? You got David Sanchez. I'm doing great. Appreciate you guys hopping on it. Finish the sentence. If people making more, Max is paying attention. Max is locked in. Max already got it. VIP members, you guys are good. Take 5. Let me see if YouTube gets it. And A1 Steph. There we go. There it is. And what is it called? Afro Podcast. Both of them got it. And Robin got it too. Beautiful stuff. And so that's why inflation can't come down. You go to the barbershop. I'm going to use a barbershop because I know you guys are all looking at this clean fade. Can't keep your eyes off of it. If you go to the barbershop and the price of the haircut went from $40 to $60, okay? If you still have your job, you're still going to go get a haircut. But now you're thinking $60 for a haircut. I'm going to go find a new barber. That's what you're thinking at work in your chair. Boss comes over and say, hey, everyone's getting a raise, inflation, whatever. It's a company thing. And everyone gets a slight raise. Wages are still going up. Or maybe you kind of get moved to a different department, start making more. Now you're like, I ain't going for a cheaper haircut. I got to look good for my new job. I look good. I just got promoted. People making more means people are still going to spend these ridiculously high prices. And as long as we still spend, the prices stay the same. That is the basics of supply and demand, by the way. If you guys want to save yourself money on econ degree, that's the basics. You want prices to come down, people stop buying stuff. We all stop going to the barbershop. What do you think they're going to do? The first day, they're not going to do anything. First week, nothing. Oh, I wonder what's going on. They post something on social media. Next 2-3 weeks, they're like, dude, lower the prices. Everyone's going to the spot across the street. Now they get competitive. You lower the prices. Still, a couple people walk in, still not enough to make it work. Then you drop the prices a little bit more closer to what they were before, but just a little bit higher. Nothing too crazy. People already saw $60. Now the haircut's 32. And then everybody comes back in. The haircuts used to be 25. People are paying 30. So long story short, we had such a big jump in inflation during the 2022, 2021 sort of inflation bubble, the end of the cycle. And then we've come down from there, but prices have not come down to the point to where they were before. And people are still feeling it. But they're feeling it and still spending. That's the dilemma the Fed has. If the Fed has two mandates, it's price stability, and making sure prices don't keep going up and down like they've been doing, and maximum employment. These two are at odds with each other. Do you guys understand what I'm saying? If we want to bring prices down, they got to make sure people lose their jobs. But if everybody keeps their jobs and we have maximum employment, which they're not going to make sure everyone loses their jobs in an election year, and so everyone's going to keep their jobs, then we can't bring inflation down, and they do not have price stability. They have three mandates. The two main mandates of the Fed are now at odds. If you guys want to read more about this, head over to chartaddictsfx.com, go to the live or go to the analysis tab right here and type in the search bar, the Fed's dilemma. I wrote about this extensively. Whoa. Oh, I don't get paid to spell. 2020, Fed's policy shifts on gold. Maybe it was a YouTube video. Oh, the Fed's dilemma was a video. And it's an article too. Bro, tell me I put it in the description. I am a absolute genius. This is called bookmarking. I go back and just look up my own articles years later. Well, this was 2022. They've been having the same problem for a while, people. I saw this thing coming from years away, from a mile away. And I'm going to use this 2-year-old article to explain how we're still in the same fucking spot. Okay. Fed promised to keep raising rates to the 2% inflation target. Positive employment numbers have given the Fed confidence to continue their path of tightening policy conditions. If the Fed continues tighten, it's going to put a strain on the economy. We're going to go into a recession. So people lose jobs. If they do not get inflation back to 2%, then the Fed's credibility is going to take a hit, and they can't afford that because literally everything depends on the Fed having credibility. Guys, the dollar, it's all a show. All right, it's all a smokescreen. The dollar is supported by the full faith and credit of the U.S. government. What that really means is we have the petrodollar system, so all global trade of oil is settled in U.S. dollars. The majority of global trade is settled in U.S. dollars as a medium of exchange. And then we have the military, obviously the military capacities, regime change, it's everything else to maintain the strength of the dollar, okay? The Fed is the manager of the dollar. Losing credibility, big no-no. And so that's why they really have been stressing this inflation thing to get it down to 2%. Talk about the Fed's mandate, the two viewpoints. Okay, so the economists are anticipating. So this is the same thing. It's been 2 years. Everyone's been waiting for this pivot. So the Fed pivot is the assumption that whatever the Fed is doing is going to send us into a recession. And because of this recession, we're going to be printing money again. And the second camp, this is the one that I was in, is the higher for longer. All right, so we're going to have higher interest rates for a longer period of time in order to get inflation sustainably back down. And the whole idea behind that is, regardless of how bad the economy gets, the Fed has to continue tightening or raising rates in order to save their credibility, which is exactly what they did. Miraculously. Let me see if I even put the Goldilocks. I didn't even probably put it in here. Yeah, see, it was a fantasy. What ended up happening was a fantasy dream. I didn't even put it in the in this research. There was a Goldilocks scenario. There was a soft landing scenario, which is the best case on the horizon. Jerome Powell could sustainably keep inflation down or get it back down from the 9% highs without crashing the economy. Like I just said, unless people lose their jobs, inflation stays up. And so what actually happened is consumer goods are still expensive. So how did they manage to get the inflation number back down? Number one, the Fed fixes the inflation numbers. They've been changing the metrics for CPI to fit their narrative for a while, and it's only getting worse. The second is that Biden had a significant impact on getting inflation back down, but not in the best ways. Some of the ways I have to give this administration credit for some of the foreign policy and some of the trade deals they did, which did reduce supply chain costs and did end up bringing consumer prices back down. But the worst thing was dipping into the Strategic Petroleum Reserve, our emergency fund of gas in the country, just to bring the price of gas down from $5 a gallon. Because of that, he depleted the SPR by 50%, made us more reliant on our three biggest threats. Not threats. Well, Russia, maybe. But we have Russia. We have Saudi Arabia, which really had some problems with us at the time. And we have Iran. We're looking at oil producing nations like, all right, we just gutted half of our SPR and we're beefing with everybody who can help us replenish it. And what do? Hat in hand, went begging Venezuela. Goofy. All right. Anyways, the executive branch, sorry guys, big tangent. The executive branch had a big hand in bringing down inflation. It was not the Fed that did that. The Fed really didn't take that much money out of the economy. All they had control over was influencing the interest rate. So they changed the Fed funds rate, which influences all the banks to change their overnight lending rates as well as their commercial and retail rates, commercial interest rates. Got it. Okay, what's going to happen tomorrow? No change. We went into this year expecting 7 rate cuts. Ain't none of that happening. So does that mean the market's going to crash? No. The market has already priced in the potential for a rate cut this year. One rate cut, I think, could have had the same effect because it just showed the Fed was not going to go back to this old policy of just keeping rates high, and that's going to be the new normal. That they were going to start to normalize rates back down and open up opportunity. Because you guys got to realize, like, I'm young, right? I used to work at Merrill Lynch, which is a Bank of America company, but even at the time, I was still young, kind of getting into the financial world. And that was arguably the greatest time in economic history to get into real estate or to get into just any investment or to borrow money at a fixed rate. The Fed funds rate was damn near 0%. And so the banks were charging 3% mortgage rates. If you had a really great credit, if you were a prime borrower, they were doing 2.5%, 1.5% rates for commercial borrowers. Insane stuff. But that's not normal. If you're young or if you just got into sort of investing or buying a house or anything in the past 3 to 5 years, the idea that we have of how life works completely screwed. And so there's been this question amongst traditional investors. Are we going to go back to like the early 2000s into the late 90s or late 80s sort of high interest rate is the new normal? They had 16% interest rates or something crazy back then. Is that what's going to happen? Or is this the new normal where we have to keep interest rates down to finance the debt so we can debase our currency so that we can pay off this massive debt that we have because we definitely ain't making enough money to pay it off. And I think that I think the path the Fed is going to go is we're going to go back down in rates. We're not going to go back to this old era of high interest rates until we're forced to. Right now we need to, but we ain't forced to. And it's an election year. So the Fed will keep rates where they are. And let's look at the predictions for the next few Fed meetings. And that's going to be it for today. CME, Fed Watch. Let's get in here. Did I lose you guys? Are we still awake? Nope, I basically lost everybody. Okay, cool. They spend more. Yep. Raising interest rates makes gold go down, right? I ain't gonna answer something like that, bro. The next Fed meeting, 18 hours away. We'll be there. 2 p.m. Eastern time tomorrow is when the report gets released, and then 2:30 p.m. is the live press conference. Okay. Based on the investments, or I guess the flows into Fed funds futures, the prediction is that there's 100, I've never seen 100% until the actual meeting itself. There's 100% chance of no rate cuts tomorrow. We know what's going to happen now, people. Anyone you see is like, oh, what if there's a rate cut tomorrow? Probably not paying attention. And so do you guys think that if we have access to this free website online, which is the CME, the Chicago Mercantile Exchange, if I'm not mistaken. Yep, the Chicago Mercantile Exchange. You think if we have this free tool that the institutions don't have access to this data, or even better, some insider data? They know there's no rate cuts coming. And so someone said it on the stream, fake down tomorrow, get everybody thinking bearish, because what if there is a rate hike? What if Jerome Powell says something crazy tomorrow and says that we have to keep rates higher for longer? If we know that that's what he's going to say, higher for longer, because he can't start cutting. If we know that, you guys don't think that the institutions know that? So fake down to grab the retail money and then straight to the moon, because if the market gives you, or if the news gives you exactly what you expected, typically there's a relief when it comes to risk assets and equities specifically. Okay? If I'm looking at this tomorrow, make a prediction, and I'm waiting for it, and the news comes out exactly as I expected, I'm going to buy it. Just like every other smart investor and smart trader, that's how we're going to play this thing tomorrow. Chart Addicts, I'm going to give you guys the levels that I'm trading at. It ain't rocket surgery. There's a whole nother heartbeat right here. Yeah, I got your phase 1. Yeah, I got your phase 2. And then I just showed you guys the continuation model. After the stream, Chart Addicts members, listen. After the stream, we talked about the bigger heartbeat. I want you guys to go to this heartbeat here on the 1 hour. Give me all 3 phases. And then we just talked about the continuation model. Let me know where we are entering down to the last decimal place tomorrow. Okay? While everybody else is trying to, oh my God, is it going to go up? Is it going to go down? Bro, interest rates, bro. Tell me to the last decimal place where we are entering tomorrow. All right? If you get it right, you get it spot on. I can't commit to a free coaching call. There's too many people. Let me walk that back. I will find some way to make, to get you guys right. But don't just let it be the same people that always answer questions. Everybody. This is how you practice. Now, if you're completely lost on the continuation model, look at the people posting their markups. Go and delete everything off your chart. Oh, but I like my drawings. You don't know shit. Delete the drawings and then do exactly what they did and copy and paste it. And until you get that shit down, I don't care about your trend lines. I don't care about your volume bars. Delete that crap off your chart. Get it right. I'm going to see you guys there. Okay? Mike, bro, I'm going to have to kick you out of the chat, bro. This is like, what was I just say? Can somebody answer this question? And yeah, not you in the front row that always answers the questions. And he just in the front row talking about, oh, it's the 1584. Fuck. Dick. You had one job. Fuck. Look at the kid in the hoodie in the back. I was asking him the question. He looks over. Mr. Krabs meme. He just surprised. Who, me? Yeah, you, brother. I'm looking right at you. And then Mike is up here, just answers the question. Guys in the back with the hoodie talking about, thank God. Thank you, Mike. Fucking Mike. This is ridiculous. I don't even know if that's right. I know. Matter of fact, I probably know it's right. I'm gonna end this Zoom before you guys write down that price, because now I'm mad. This man, Big Mike. All right, everybody. Quick reminders. Also, the NASDAQ Masterclass is in 2 days. If we have not filled out seats yet. If we do not fill out the seats in the next 2 days, we're going to extend the start date for the masterclass until we pack this thing out. We don't want to have to keep doing 2 a month just because of the folks that weren't able to get in. So we're going to do 1, make sure everybody gets into this one, because once we go on tour, it'll be much tougher for us to connect with everyone. Okay. So make sure to head over to chartaddictsfx.com. The link is in the description. FX Summit 2024. Early bird tickets end in 11 days. All right. 50% off tickets are still available for early bird for the next 11 days. Once we go and start announcing all the speakers, all the exhibitors, all the sponsors, prices are going to go to full price. Make sure to grab those before it's too late. And last but not least, new video just dropped on the channel with Peter Tuchman. Go ahead and check that out. Incredible. It's a small piece of the interview that we did at the New York Stock Exchange, but it should give you guys an idea of how the full interview is going to go. And we just kind of clipped up like 5-7 minute pieces so you guys can hear some of the conversation. All right, go check that out after this. Take it easy. Happy, safe trading. See you guys tomorrow for FOMC. Peace. All right.